Joining us is Wells Fargo's Sarah House. I mean, we are looking at these yields making new cycle highs as we speak. Got a surprisingly strong job openings report. How much higher can yields go?
Well, I think what we're seeing is this reaction to the economy not just hanging in there stronger, and that's affecting expectations for what the Fed does. But I think a lot of the supply considerations that you were just discussing. So everything from the current position of the deficit, but also QT ongoing. And so I think, you know, it remains to be seen just how high. But I think a lot of it's going to be affected by also what the Fed path does from here. And what the latest economic data suggests is that certainly higher for longer, and I think it really keeps the potential for perhaps one more rate hike this year on the table.
So beyond that, Federal Reserve's talking about higher for longer. It'll rest right on the economic data and the inflation data. So where does that go? Does the tightening of financial conditions that we are witnessing now in terms of rates and the dollar and everything else do the work for the Fed so that they can get on to cutting faster?
I think it certainly does help. So this is one thing that we hadn't seen throughout this entire tightening cycle is the Fed would be raising rates, but we would actually see financial conditions ease during periods. And so I think there was this idea that, well, if financial conditions ease, the Fed can either just keep at it, keep rates elevated for longer until you see that pass through, and that is what we're seeing. And so I think, yes, to some extent this does the Fed's work for it. So that's by design. The Fed's interest rates work through those financial channels. And when we look at, I think, the tightening we've seen in financial conditions, that suggests that we haven't seen the worst of the slowdown in growth. And while prospects, I think, have improved over the past few months for a soft landing, the debate is far from settled with these real rates, I think, likely to further dampen growth.
And you say that there's going to be a slowdown in train. We have seen things like the leading indicator has been pointing that way for a very long time. Growth has continued to surprise to the upside. Where do you actually think we're going to have that final point where things become too much, frankly, for the economy? And is the Fed really looking for that? Because they have said that they're obviously looking to be restrictive in their policy. At the same time, they upgraded their growth estimate for next year. It's still below 2% real.
Yeah, so I think a real test here is going to come in the fourth quarter, where you do have accumulating headwinds. So not only do you have the ongoing headwinds from tighter monetary policy that is increasingly restrictive in real terms, but you have this increasing effect of the fading fiscal support. So everything from that continued wind down in excess savings, the restart of student loans, the child care cliff. And so I think you are going to see consumers increasingly squeezed with perhaps a bit of a jump in that dynamic here in the fourth quarter. But I think it's really the slow squeeze that we're looking for, where we think things continue to moderate as we move through the first part of next year.